Bloomberg Audio Studios. Podcasts, radio, news.
This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. This week, a Chinese startup triggers a tech sell-off, raising questions about whether the Magnificent Seven can continue to drive the stock market. Plus, the fates of office buildings in New York City. Some are glitzier and have more to offer their tenants than their Class B counterparts, but they have more in common in the challenges they face than meets the eye. But we begin with a story about goals, how we set them, how we achieve them, and how we change our behavior to make sure we do. Goals like the Federal Reserve's goal of achieving 2% inflation over time.
Inflation has moved much closer to our 2% longer run goal. Our 2% objective, moving down to 2%, but get back to 2% inflation, our 2% objective. Sustainably down to 2%. Confidence that inflation is moving sustainably toward 2%.
Given how often we hear about that 2% inflation goal, you'd think it was just obvious, but it's not.
I do think to the public, there is this question, why can't the price level go back to what it was before? Why even have a 2% inflation target?
I always get questions about it, even before the pandemic, before the run-up of inflation. Why isn't it zero? Why aren't we aiming for zero instead of aiming for 2?
The question I'm asked the most on this is, did you just pluck that number out of the air?
And over the years, the Fed's 2% target has come under question from those that follow it closely. So where did that 2% inflation target come from? For that, we have to go all the way back to 1990 in New Zealand, when Don Brash was the RBNZ governor.
New Zealand had had very high inflation certainly by OECD standards anyway. Double-digit inflation figures through much of the 70s and early 80s. And the then Labour government decided that they were going to get inflation right down. In 1988, the Minister of Finance asked about inflation dropping below 10% for the first time in some years, said, well, aren't you satisfied now? And the minister said, no, I'm looking for zero inflation, or maybe 0 to 1%. Over the next couple of years, that was modified gradually. So the target became 0 to 2% by 1992. And that was the target that I signed up to. Subsequently, of course, the target was slightly amended, and we went to a target at midpoint of 2%. We could explain to people what we were targeting. People understood the game. And in the early years, particularly of my time as governor, I spent a huge amount of time talking to farmers groups, Rotary clubs, church groups, any groups that would listen, making it very clear that we were deadly serious about achieving that target.
And from there, it went worldwide.
Inflation returns to our 2% medium-term target.
Inflation is now back to the 2% target.
Inflation has been close to our 2% target.
Canada followed suit, then the UK and others. And in early 2012, the U.S. adopted the 2% target.
The committee judges that inflation at the rate of 2% is most consistent over the longer run with our statutory mandate. Clearly communicating to the public this 2% goal for inflation over the longer run should help foster price stability and moderate long-term interest rates, and will enhance the committee's ability to promote maximum employment in the face of significant economic disturbances.
John Williams, now the New York Fed president, was in charge of the San Francisco Fed when the policy was adopted. He recalls that the motivation was transparency.
When Chair Bernanke came to the Fed, clearly he had strong desire for us to continue the work on transparency, be clear about our objectives, which actually had started under Chairman Greenspan and a lot of movement toward transparency then. So going back to January of 2012 and the discussions that led to that, I had just joined the FOMC in the spring of 2011, so I was there for that. And it was really a focus on greater transparency, greater clarity about what does good look like. We don't want inflation that's too low, we don't want inflation that's too high, and importantly, what's the inflation rate that's consistent with the dual mandate that the Fed has, which is relatively unique to the Fed.
Good afternoon.
But the urge to have a clear, transparent inflation goal didn't mean that the goal necessarily had to be the 2% one that other countries had adopted.
With 19 participants, or however many were in the room at the time, there's always a wide range of views. So if you were to ask the question, is 1.5% or 2 or 2.5%, are those right or wrong answers? I think any of those answers would work. I think 2% is a good, kind of Goldilocks answer.
Given what other central banks had already done by 2012, Chair Bernanke's announcement was hardly a shock. But it did spark plenty of debate. And one of the voices initially against the target was the current Chicago Fed President, Austin Goolsbee.
I wasn't in the Fed at that time. I was actually kind of publicly critical that 2.0% conveys a false sense of precision. That inflation's a noisy series. And just telling the difference, if I told you how many months of inflation data would it take, given the variability of the series, to tell the difference between a 2.0% inflation rate and a 2.2% inflation rate? And the answer is years, if not decades, of data before you would be able to even tell the difference. So that's why I was kind of critical at the time. But that said, I've completely changed my view, and I'm now a strong advocate.
Whatever the pluses and minuses of the Fed's 2% target were when it was adopted over a decade ago, it's now well established, and the markets have come to depend on it. The Fed has a 2% inflation target on average. How does that affect the markets?
It's extremely important. So I'll start with that because, and having that credibility that it is 2% over time, because what we do is the market is essentially pricing in an expectation and a risk around the expectation over time.
Priya Misra is a portfolio manager at JP Morgan.
So now if my inflation is somewhat understood, then I'm pricing real rates over it. And so I'm talking about the treasury curve. It contains that treasury curve, the inflation part, then we have to just price in where are real rates. So I think it helps anchor expectation. It also tells us how should the market price in the Fed response to, either another policy shock, fiscal policy, or a shock to the economy.
For someone dealing daily in the markets like Misra, the fact of simply having a clear target is more important than exactly what that target is.
Somewhere in the 2 to 3% range is fair. Now the Fed in 2012 picked 2%. It's somewhat arbitrary. You could have picked 2.5, but they picked 2. I think it's a fair number. It allows the Fed, if you think the Fed doesn't want to go to negative rates, and look at Europe and Japan, it's not clear the negative rates were that effective. In fact, they have all these negative externalities. It allows, if inflation is at 2, it allows real rates to go negative, because if Fed funds gets to 0, that's a negative 2% real rate, which is very stimulative for the economy. So I think somewhere in that 2 to 3% range is important.
As much as the markets rely on that fixed 2% target, does it matter that the Fed doesn't hit it all that often? Since Chair Bernanke announced the target in 2012, it's been within 0.2% of target in only 20 of 155 monthly readings. And in more recent times, inflation has been stubbornly stuck above the target. After peaking in 2022, the core PCE, that's the Fed's preferred inflation gauge, showed signs of progress when it fell to 3% in 2023. But since then, it's largely flatlined, leaving some to speculate about possible upward risks to inflation, given an economy that appears to be running hotter than anticipated, perhaps because of structural changes. But suggest changing the inflation target at this point to those in the markets, and you get a strong reaction. The Fed has said we're not looking at the 2% target right now. Let's assume a counterfactual. What if the Fed tomorrow came out and said it's not 2%, it's 2.5%, maybe even 3%? How would the markets react?
My blood pressure is increasing just as you say it, because it's a Pandora's box, right? You start with, it's just a 50 basis point increase. It's a slippery slope. A year later, well, maybe it's another 50 basis point. Once you open the door to any increase in the inflation target, I think the market has to price in the risk that could continue to rise. Given where inflation is right now, above target, I think it's disingenuous for the Fed to raise that target. It's like me trying to run a marathon, and then when I realize it's really hard to run that much, I just lower my target to a 10K. Not that I can run a lot, but it just doesn't sound credible.
We said the target is 2%. And once you set a target, that is a sacred promise that the central bank has made. And you can't debate coming up with a new target just because you're not hitting the old target. You got to finish your job before you start looking for a new job.
I would say on inflation, it all comes down to expectations. So why do I think we should take the inflation target for granted? Is because expectations, it would be great if inflation expectations are well anchored. Because then if I'm a business, I can plan for pricing, I can plan for my investments over time, because I know this is where inflation, roughly speaking, on average will be over time. If I'm a household, I can have that same expectation. If I'm an employee and I'm going to ask my employer for a raise, again, I have a sense of where that is.
But for all the benefits of setting expectations for overall inflation with a simple, single goal of 2%, it doesn't mean that everyone will experience the same level of inflation across all socioeconomic groups, industries, or geographic areas. And after a sharp ramping up of inflation, those expectations don't return us to the prices we knew only 3 years ago. So that is where we turn next. How people are affected by inflation that hits us all differently.
People feel the higher prices. I feel the higher prices. And when I go and explain, well, inflation is coming down, of course, they don't see that because they go to the grocery store, as I do, and prices are still high. I do the grocery shopping for my family. I still have sticker shock. I haven't adjusted in my expectations about what normal is when I go to the grocery store.
When we come back, our colleague Michael McKee brings us a story of how Americans in the Midwest react to inflation when it hits them, and why they may not always feel as reassured as the markets about that 2% Fed goal. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. Now we continue our look at inflation, the Federal Reserve's target rate, and how prices are felt and viewed differently depending on where you live. To tell that story, we bring in Bloomberg's international economics and policy correspondent, Michael McKee.
The Fed is steadfastly committed to bringing inflation back down to 2%. That much is clear. But inflation is felt and measured differently all across America. Those in the Midwest may feel differently about the Fed's progress than those in the markets. While inflation may be slowing, for many, prices remain high, posing a challenge for businesses across the country, such as one restaurant on Chicago's South Side.
We're known for the best brisket in Chicago. We work really hard to provide the area with true craft barbecue. Our customers are regulars here because they love the atmosphere. Brisket.
Dominique Leach is the owner and chef at Lexington Betty Smokehouse on Chicago's South Side. She opened in 2019 and, like other restaurateurs in Chicago and across America, has seen firsthand how the surge in inflation over the past 5 years has affected small businesses.
I'll bring it over to you when it's ready, okay? Thank you. Everyone's favorite, our brisket that we're known for. 2 years ago, I was paying $3.80 per pound. Today, I bought brisket for $4.60 per pound, which means we have to sell it at a higher price. Inflation is really affecting the restaurant because we have to spend more money on product, therefore increasing the prices for our customers. It makes it really uncomfortable. You typically have to give people an explanation. Why is brisket by the pound more this week than it was last week? It disappoints people.
The challenges facing Leach play out across America, even as inflation falls from the dramatic highs of 2022. A recent survey found that 24% of small businesses identified inflation as the top problem they face.
I think one of the things that we've learned in the last 2 or 3 years is people really, really hate high inflation.
But do people who aren't on Wall Street even care that the Fed has a 2% target? The impact of inflation is often felt more acutely in rural areas where household wealth tends to be lower. With far less disposable income, those earning the least have to dedicate a greater proportion of their income to everyday necessities. That divide is compounded by the fact that wealthier Americans, often found in urban areas, have relied on a booming stock market to increase their wealth and offset some of the effects of inflation. Is the experience of inflation different here in your district in the Midwest and to the West than it might be in New York on Wall Street?
I think so. I mean, I think especially when you go out to rural communities, we have a lot of rural areas, the challenges that families are facing are different. I mean, they're all facing the higher prices that virtually all Americans have faced, but they also have acute challenges. Hospitals are closing in many rural districts because there's not enough population to support those hospitals. In some cases, colleges and universities are closing. It's hard to get home construction built, even though there's a lot of land available, getting new construction and new development built. So the challenges in rural communities are different, but a lot of times they're driven by price as well. So there's some important similarities, but there's some specific differences in rural communities.
For the likes of Neil Kashkari and Austin Goolsbee, a large part of their districts cover vast rural areas, while a big focus in John Williams' jurisdiction is naturally on Wall Street in New York City, where analysts and traders immediately dissect any inflation data, not just looking at the headline number, but peeling back the layers to look at individual contributors, which can vary widely.
You get the headline number, the core number. Literally the next second I look at services. So services versus goods. Then I look at where's shelter. And what has been high, so what's keeping inflation high is not a broad-based higher inflation across. Then I would be a little nervous that are we getting stuck somewhere above 2? It's really a couple of components. It's shelter, it's lagging, Zillow rents are coming down. It's just taking a while. People who own their homes, it takes a while for that to show up in the data. So there's a lag there. Auto insurance, medical insurance, these are imputed numbers. That's why I think it's actually good for them to have that flexibility, because why should they keep policy high just because shelter inflation, which is owner's equivalent rent, is running above target just because it's adjusting slowly.
For those in the markets every day, like JP Morgan's Priya Misra, communication is a critical part of a Fed president's job, and a clear target, 2%, makes that job a lot easier.
Well, you know, inflation is different in different parts of the country, and it can be different at different times. I think that, you know, where this became easier, unfortunately, was when inflation was high, and everybody said inflation. It was high everywhere. Inflation was clearly damaging to the economy. It was harmful to families and businesses. Everybody wanted to see inflation lower. I think the communication of the 2% goal was incredibly powerful during this period, because we weren't questioning what we should get inflation to, what does good look like. We said absolutely, we need to get to 2%. We're consistent on that. And I think people understood that, the importance of price stability, the importance of getting inflation back down. I think that was, you know, regardless of all the debates of exactly how did you come to 2%, it was a very clear, strong message. It's a message that Chair Powell repeated over and over that, you know, we're not compromising on achieving that.
That's not the kind of analysis Americans elsewhere are making. They see inflation in the supermarket, at the pump, and in their rent. They're still coming to terms with so-called sticker shock, something Goolsbee and Kashkari say requires a different kind of communication.
We do a lot of conversations with labor unions, and one of the sources for me of information about people's expectations, you know, in economics we talk about expectations matter, inflation expectations matter. We talk to labor groups about what wage rates they're negotiating in their multi-year contracts to look at what is the inflation embedded in their own thinking looking ahead 2 to 3 years. Now, as they're having their negotiations, they may not be thinking, well, my inflation expectations are X and I need this kind of wage growth. But it's clear that inflation is woven into the fabric of their thinking about the economy and the future. So it does register. They may not be as technical as a Wall Street analyst in how they talk about it, but it's present in their thinking.
Inflation is eating away at the funds available.
Go back to the inflation of the 1970s, 80s, Paul Volcker's time in office, and people would do things like bring 2x4s and throw them in front of the Fed because they were mad at the level of interest rates. You're in a kind of ironic situation. People hate inflation, but they get mad at the people whose job it is to fix it.
Now, look, that's true. Nobody's ever like, my greatest central banker. They're just mad if you don't do the job to keep inflation low. I was a close personal friend of Paul Volcker. He's a personal hero of mine and mentor. His widow, Anka, gave me that original 2x4 that they sent to him. Somebody scribbled on the top of it, please reduce these insane interest rates. And I keep that in my office on the shelf right next to my desk here at Chicago Fed as a reminder of two things. One, the decisions that the central bank makes affect regular people, regular businesses, regular consumers quite directly. And two, sometimes if it starts going wrong, you got to make tough decisions. What we want to, once we're in this experience, is have wages growing faster than prices. And the good news is, lately, that's what's been happening. And as productivity grows, we can do that even more so. But if you talk to regular people, I kind of think the world of inflation targets is not in their space. They're like, why is it so expensive?
The dynamics you just described about wages and prices, I imagine that most of the people you talk to when you go around in the district and speak, they don't understand that. They don't think of it that way.
I think it's true that most people do not think of it that way. And if you look in the surveys, they're extremely upset about inflation. And then if you say, but look at your wages, they tend to say, I earned the wage increase I got out of my hard work. The inflation I had nothing to do with, and so that's the part that makes me upset. They are, in reality, tied together, wage growth and price growth.
On the surface, wages are growing faster than inflation. The latest reading had wage growth at 4.2% compared to an inflation print of 2.9%. Wages are going up, but are they going up enough to offset the significant period of time where high inflation comfortably outpaced any growth in wages? It turns out that since the end of 2018, inflation still outpaces wage growth overall. And who's benefiting from that wage growth anyway? While all income groups have seen wage growth in the last year, historically, America's wealthy have seen their average earnings grow 46.2% since 1979, compared to just 17% for its lowest earners.
The overwhelming message that we've received and that I have received is, hey, high inflation is really bad. It was very painful for my family. It was very painful for my business. Get it all the way back down. They might debate whether 2% should be the right target or 1% or 0, but get it all the way back down to what we were used to before the pandemic.
And they probably couldn't necessarily put an exact figure on what they were used to before the pandemic. So I wonder, is the 2% target necessary?
It is necessary. It's necessary because those Wall Street analysts that you talk about, they are very active in financial markets. We know that most financial products ultimately get priced off of, for example, the 10-year Treasury market. So it is important that the people who are professionals in investing and in forecasting understand what we're trying to do and have confidence that we're going to achieve it. So I do think having a specific numeric target is very helpful. It becomes self-reinforcing the more we demonstrate our ability to hit it. But it needs to be a low enough number that people on Main Street don't need to spend their time thinking about it. They have better things to do with their time than thinking about inflation. That's our job, to get it back there.
From Wall Street to Main Street, inflation is felt by all. And target or no, ultimately the real goal is former Chair Alan Greenspan's definition of price stability, when people don't think about inflation at all.
Our thanks to Michael McKee, our international economics and policy correspondent here at Bloomberg. Coming up next on Wall Street Week, how office buildings in New York City are not created equal, but finding capital and tenants might be the great equalizer. I'm David Westin, and this is Bloomberg. This is a story about sibling rivalry. Two members of the same family sharing many of the same traits and sometimes competing with each other, but who lead very different lives. Office buildings are part of the life's blood of New York City. They come in a range of shapes and sizes.
Typically, the marketplace is stratified between the A product and B and C product. And A covers a wide definition of quality buildings, generally buildings of a newer vintage, but in New York City, where the average age of buildings are 65 years old, newer in New York City could mean a building that's 30 or 40 years old. But it's generally buildings that are well located, have either new vintage or have undergone heavy redevelopment, big capital spends over the past several years, have modernized infrastructure, have efficient floor plates, higher ceiling heights, and things that people find important in today's work environment. But within the A product, then you have the marquee product. You have the best of the best.
Stephen Durrells is Director of Leasing and Real Property at SL Green and is responsible for One Vanderbilt, the new office tower looming over Grand Central Station. The way the New York City Comptroller keeps score, about 60% of all Manhattan office space has some form of A grade, but the top 5-star rating is reserved for only 13%, leaving about 40% with a grade of B or below. Ruth Culp-Haber has spent her career putting tenants into those millions of square feet of New York office buildings. For her, the category of the building makes an enormous difference in getting them leased.
To say this is a tale of two cities is an oft-used, somewhat tired metaphor at this point, but absolutely true. So let me paint a picture. You have the A buildings, such as One Vanderbilt, Hudson Yards. One Vanderbilt, 1 block from Grand Central. The building's full. It just opened during the pandemic. $200 a foot in rent is the last deal they did there. You go 2 blocks from there, and you have the Chrysler Building, and you have 230 Park Avenue, the Helmsley Building. These are icons of New York City real estate. These are the grand dames of New York City office buildings. Both of these buildings are in default on their mortgages and are a good percentage empty. So that is what I would call a tale of two cities.
One Vanderbilt falls squarely in the premium marquee category based on location and amenities.
Infrastructure, healthy work environments, a big amenity package, and things that really address people's, how they want to operate their business and what allows them to operate their business from an infrastructure point of view. So that is a unique part of the marketplace, and that part of the market commands a distinct rental premium over everything else in the Manhattan marketplace.
Jeffrey Goral operates in a very different part of the Manhattan office business, owning and operating what are called B buildings. He comes from a family of real estate developers and has been in the business since the 70s. He's now chairman of GFP Real Estate, formerly known as Newmark Holdings. We talked to him at one of his buildings located at the corner of 8th Avenue and 26th Street in the Chelsea area of Manhattan.
You'll find a number at which point people will rent it. It sometimes takes a while to figure it out. But when I was much younger, we bought a building on 8th Avenue, 505A. And I was trying to rent the space for $16 a foot. And when I was young, said, lower the rent to $13, you'll fill it. And exactly, I lowered the rent and I filled it. Because it's supply and demand. The guy wants to pay $40. He's looking at all the product that's out there at $40.
As much difference as there may be between the marquee One Vanderbilt and GFP's 322 8th Avenue, they both face some of the same challenges, like the pandemic and the effect it had on people just not going into the office, whatever class it was.
What's really killing the office space industry now is a trend that began before the pandemic, but then was accelerated dramatically during the pandemic, which is working from home. Before the pandemic, 2019, the statistics are there were about 7% of the workforce working from home. But once the pandemic started, and then now we're at about 28%. So it's a 4 times increase. And it's had a huge impact on the office space market.
The pandemic was brutal because people just stayed home. Everybody stayed home. I stayed home. Luckily, the government did this program where they allowed companies to apply for a loan, and they could only use it for rent, insurance, and to pay their employees. So, and then eventually the loan would be forgiven for the most part. So that helped us enormously because the guy, legally, they couldn't put the money in the pocket. They had to use it to pay rent. So that kept us in business. And then gradually, when the COVID, people started to come back to work, initially 2 or 3 days a week. Now it's like our company is 4 days a week.
But the seismic shock of the pandemic still didn't keep SL Green from opening its One Vanderbilt in the middle of the shutdown. You opened, actually, during the pandemic in 2020. Did that change your plan at all?
It didn't. It certainly gave us a few moments of pause as to what it meant for the real estate market, what it meant for Manhattan overall.
The grand opening of One Vanderbilt, it's the recovery.
But we were actually designated a critical building to Manhattan because a lot of our tenants were financial service tenants that were signed up during the construction period. So when we opened up, we were 60% leased at that point in time. And we literally cut the tape and opened the doors for businesses in September of 2020. So just as the world started to awaken coming out of pandemic. And I think, lesson learned, there was even a new appreciation for this location in this building coming out of the pandemic, largely because of its convenience to transportation, where if you think back how people, they don't want there used to be the commute, the inconvenience of commute, and then all of a sudden it was, I really don't want to do a 2-leg commute, get on the subway after I've come off a train from my suburban home. So the proximity to Grand Central made it even that much more desirable, but also the focus on a healthy workplace environment. Clearly, all of our tenants went through some period of reflection as to whether or not they were going to have some element of a hybrid work environment or some portion of their employees would permanently work from home.
Another challenge shared by Marquee and B office buildings alike is the need to get financing, which means real sensitivity to interest rates.
There's no doubt it is tremendously difficult to capitalize new construction in today's world. There's only a handful of players in New York City that have the financial resources to really have access to capital, have a balance sheet where they can bring their own resources to bear. It is rarefied air to find developers who have that capacity to skill set to build, ability to assemble sites, access to capital, and really have the vision in order to come up with a design that meets the market and anticipates the changing market as the years go by.
And that sensitivity to rates gives a big advantage to those able to borrow less. People like Jeff Gural, who was able to buy his B buildings at affordable prices years ago and resisted the temptation to leverage up when rates went so low.
I think we bought for $5.5 million. And the reality is that the tech guys would rather be in Soho, Chelsea, Tribeca, the Village. So those are the buildings we own because we weren't rich enough to buy the glass buildings. So we're in pretty good shape. It's just, you got to have the money and you got to not be over leveraged. It's a simple business. If you have too much debt, you're screwed.
So what sort of leverage do you typically see in an office building?
I think typically I've been through so many ups and downs. You learn, don't get greedy. It's very tempting to borrow too much. Right now, the buildings are my favorite buildings are the ones that have no debt because I don't even have to think about it. Fortunately, I was smart enough to see the handwriting on the wall, and I took all the buildings that were low leveraged and refinanced at the beginning of 2020. So I have a lot of 10-year loans at 3.5%, 3 3/4.
In the end, though, it's not about how well financed the building is. It's about providing a space that makes people want to work there, something One Vanderbilt was designed specifically to do.
What really distinguishes the building are things like super high ceiling heights, column-free floors, infrastructure that can support any kind of business, meaning lots of air conditioning, lots of electric capacity, and amenities. Amenities that come in the form of shared meeting spaces, a shared auditorium, boardroom that we make available to the tenants, a food and beverage program where we have 2 one-Michelin star restaurants operated by a world-class chef, Daniel Boulud, and a building that's oriented towards a healthy work environment, which in a post-COVID world took on an importance that none of us really appreciated before COVID. The amenity offering specific to each
It just isn't realistic to expect a good, solid B building like 322 8th Avenue to compete with the likes of a One Vanderbilt. And Durrell says there probably isn't an appetite to build a lot of new B buildings in Manhattan anytime soon. But that doesn't mean they don't have a future.
I mean, there is a bit of a misnomer that to believe that there is no reawakening in the B market. We're starting to see that mid-price point product come back to life. Now, as I said earlier, we're oversupplied with that product, but there is a place for certain businesses that can't afford $200 a foot rents that want to pay $60 or $70 or $80 a square foot. And there's an opportunity to reposition, some portion of that marketplace with new capital investment, to bring in new infrastructure, amenitize those buildings, particularly those that have proximity to public transportation.
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. Join us next week for more stories of capitalism.